Hi, this is the first lecture of Chapter 1, and we're just going to take an overview and look at the first objective. My purpose on these lectures is to just touch on the overall objectives from the text PowerPoint and then really kind of focus on some basic problems. However, in Chapter 1, because in Chapter 2 and Chapter 3, in the beginning of this course, because the concepts are so important later in the course, I'm going to spend a little bit of time here um, going over some of the concepts. And so here are all the objectives we're covering. We're covering all the objectives in this chapter, and we're going to move on in this video to 1.1, explain why accounting is the language of business. So if you think about language, it's a system of communication, and accounting is a system of communicating business activity. So it's really that simple. Like any other language, it has a special way of communicating. You have a different word to reflect different objects, and they have different meaning. So part of your accounting education is whether or not you're going to go into accounting as a profession, but as a business person, is understanding what is meant by particular terminology. Um, so another aspect of communicating is to whom. So we have different types of accounting, and your textbook mentions management accounting. They mention also financial accounting. Financial accounting is the focus of this course. Having said that, the tools you're using are tools that are used in a lot of other types of accounting. For financial accounting, we're communicating to stakeholders outside the organization. Management accounting is for communicating and decision making inside the organization. And another type of accounting you may be familiar with is tax accounting. In that type of accounting, you're communicating taxable activities to the IRS. But our focus here is going to be financial accounting. Once again, a lot of the things that you're going to see in this course in other types of accounting you'll see used, but there are aspects of this course that are particular to financial accounting. So we're going to have an external reporting focus, and we're going to avoid releasing proprietary information unless we're required to. So we're not going to release uh, company secrets or information we wouldn't want our competitors to know. This information is primarily for the benefit of investors. Investors are equity investors that are owners or creditors like banks that lend money to the corporation. Financial accounting has significant regulatory support in the U.S. and also around the world. There's federal law. There's the U.S. Securities Exchange Commission Act. So U.S. Congress gives authority to the U.S. Securities Exchange Commission. There's also a bunch of court cases. And the Financial Accounting Standards Board, the AFASB, is actually delegated the duty of creating accounting principles in the U.S. So in the U.S., oops, got a little bit of in the U.S., publicly traded companies are required to file financial accounting reports. Because of that infrastructure, a lot of other organizations may require it. So if you have a bank loan, you may be required to get a financial accounting statement to the bank, even though it's not required by law, just as a matter of the contract with the bank. And these reports have to comply, they have to be in compliance with accounting rules that we call generally accepted accounting principles. And in the U.S., it's U.S. GAAP, but we just call it GAAP. There's could be French GAAP or Argentinian GAAP. Different countries have their own principles. Um, so, as I mentioned, some business contracts may require financial accounting reports or credit rating agencies. Other countries may apply, instead of GAAP, international financial reporting standards. All right, so you should be aware that there are other accounting principles out there. the most widely used outside of US GAAP is International Financial Reporting Standards, but we are going to be focusing on GAAP, US GAAP. Still in objective 1.1 here. So it's a system of communicating business activity. And who is it for? We mentioned, even though there are different types of entities, it's for business organizations that are for profit. Not for profit and government entities, they don't use exactly financial uh, accounting standard, or they definitely don't use GAAP. They use a type of financial accounting that's particular to them, but a lot of the things you're learning will be applicable. But when we think of why are we doing this, our focus in this semester is going to be business organizations. And you may have already seen there's several different types of business organizations. So the structures that a business organization can take on. A proprietorship is you own a business. You say, I'm going to start cutting grass. That's my business. Um, you are individually liable, but you don't pay corporate income tax. You only pay your personal income tax. Partnership, you and a friend start cutting, have a grass cutting company. You have joint and several liability. So if uh, you your buddy can't help pay the debts, but you can, you have to pay. But there's still no corporate income tax. And then there's also this thing called limited liability corporation. No corporate income tax, but it does have limited liability. So that's the benefit. We're really going to be thinking about corporations when we do our accounting, although financial accounting is applied by the other types of corporate entities. So financial accounting applied here also, but this is really our focus or what we're going to keep in mind when we do our reporting. In some instances, some of the accounting we're going to do would be identical. Doesn't depend on the organizational structure, but a corporation that pays corporate income taxes, the organization we're thinking of. They do have, these organizations have limited liability and generally greater access to capital investment. So that's why you might form a corporation. All right, so how is it communicated? This is really the how is really where you're going to spend most of your time this semester. So something happens in the world and then we apply US GAAP and translate that into numbers in our accounting system. Okay? So this GAAP framework here is a foundation of how to look at things, and it has a primary objective to provide information useful to existing investors, and the other the next part of the framework is that the information should be relevant. So either it would change an investor's decision or at least improve their assessment. So sometimes you get information that makes you change your mind. Other times you get information, you made a decision without it and you were pretty confident, but you weren't sure. You may make the same decision, but now feel more confident about it. Either way, it's relevant. The other fundamental qualitative characteristic is that it's faithfully represented, or can be faithfully represented, so it's complete and free from bias. So it's not consistently overstated or understated. So those are the two fundamental qualitative characteristics. So there is this underlying framework, um, and then here are some other principles that underlie it. All of this is just to give you a flavor that there's a um, logical foundation to how we're going to proceed creating accounting rules. So the first thing here is an entity assumption, economic unit separate from its owner. So if you start your lawn mowing business, you account for the lawnmowers and maybe loans for those lawnmowers separate from your own personal money and resources and debts. Going concern assumption. We assume that the entity is going to be in business for the foreseeable future, that we're not accounting for it going out of business this year. The historical cost principle. This idea is that if if you have your business with the lawnmower, you buy the lawnmower for $3,000, that's what you're going to record it at. It's not that it was at sale it used to be 4,000 and the sale price was 3,000. So now you're going to record it at 4,000. You record it at what they actually transacted at least initially. Stable monetary unit concept. We're in a period of low inflation, so this doesn't really mean a lot to us now, but sometimes inflation is higher, and some people think, well, you should adjust for the inflation that's occurring, but under GAAP, amounts are not adjusted for inflation. So these are some definitions and terms that you should be familiar with for quizzes and exams. But these are also the assumptions and principles that build the accounting treatments that you're going to work with. Okay? So that gets us through objective 1.2. And we'll move on to objective 1.3 in just a second. If I can figure out how to turn this thing off. Okay.